Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker and financial columnist and best-selling author, Tom Martin. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're introducing you to how an insurance carrier operates an index universal life policy, all from Tom's popular article, Are Caps and Floors in UL Realistic, and his best-selling book, The Other 8 Advantages of Universal Life. Well, Tom, everybody, it is the number one product right now for income. Absolutely. A lot of people still sell par whole life, still sell UL, a regular current assumption, not that much, but they still do it. People sell variable because they still like the S&P dividends and they're willing to take some risk and so forth. But index by far, from an income point of view, is really the chassis of choice.
Absolutely.
But everybody that I know, and Tom, I have to say, when I first read your article, I was stunned at the comments that came from your article. You just drew the flies because nobody knows the operations. And all this week with this whole entire series, we're going to try to explain how does indexing work. And you might even learn a few little option tricks for yourself. Why did you write the article in the first place?
Well, first of all, Steve, I was a big fan of indexed annuities since probably the mid-'90s. And my clients have had very good results from that. So when Indexed Universal Life came out, about 10 years ago is really when it hit the streets, I was already somewhat pre-sold, but I would see these caps and floors, and they were so much greater than index annuities, and it didn't really make sense to me. So I was comfortable with the product, but I was wondering if the insurance companies were maybe over-promising. And I set out to figure out how the math worked, and that's what led me to write that article.
When you went out to look to see, did the insurance companies actually have this knowledge, or did you have to go to their option traders, or how did you know that? Where to start?
Well, I spoke to several product actuaries, and they all kind of alluded to using call options, which I knew is what index annuity carriers did. But they didn't really give me the specific mechanics of how it worked. So I kind of went out, and I was actually having lunch with a client, explaining an IUL product to him, and he really liked all the tax advantages of it. And he was a very financially sophisticated type of buyer. And he said, you know, that indexing thing doesn't really impress me that much. I can do that in my own portfolio. And I challenged him. I said, I don't think you can. The insurance company has some advantages that an individual investor doesn't. So after lunch, I figured out if I had a client that asked me to develop an investment strategy that would track the S&P 500 subject to a cap and a floor, how would I design that? And then how would I design it if an insurance company asked me to hedge an IUL portfolio? So that's what got me to doing the math.
This is a big myth because I think some sophisticated investors do believe, hey, I could just do this. This is a matter of making some calls and the proper spreads in option trading, but it isn't really. This is something that is kind of unique to not only institutional investors, but carriers, insurance carriers.
Well, I think the typical investor says, well, I'll invest in a securities portfolio and I'll buy some puts to protect myself from the downside. But the problem with that is, if you buy the puts to protect from the downside, it's taking money away from what's invested. And that's not the way insurance companies do it. The insurance companies invest most of the money in their fixed portfolio, in their general account, and they buy call options to credit the upside. So it's almost the reverse. They start off with covering the downside, and then with what's left over, they provide the upside potential.
Now, Tom, you have serious top of the table and Forum 400 production. I mean, you've done some serious premium over the last couple of years. So when I'm looking at your production, and not only that, you're highly credentialed, you're a CLU, CHFC, CFP. So when we're talking about these things, you are a retail advisor to clients, consumers, and they want to know these things. And you sell a lot of this. So when you dug into this, what about the ability of a company says, you know, our caps didn't, you know, our performance didn't do it well? They could drop the caps on this.
They can.
I mean, did that bother you as a regular advisor?
It didn't bother me because that's part of the product design. That cap is supposed to move. Again, selling a lot of indexed annuities, the caps today are much, much lower than they were when I sold them, but they're still very good products. When I was selling indexed annuities, and I've got one myself that I bought 12 years ago, the cap is 10%. Well, you don't see that in an indexed annuity. You see it in Indexed Universal Life, but indexed annuity caps are generally somewhere around 2 or 3% on the 1 year point to point.
I mean, so a lot of people always ask me, why, Steve, if it's the same company selling an index annuity with an index life, why are the caps so low on the annuity? And it seems to be a lot more generous on the life side of that equation.
Well, there's a couple ways to answer that. One, in annuities, the carrier really only makes their money by the spread. That means they invest more than they invest at a great rate than they pay their clients. With an indexed universal life, there's several ways companies make money. They make it on mortality costs, they make it on policy fees, they make it on surrender charges. The other thing that allows them to offer such higher caps is surrender charges. They start out generally at about 100% and they last 15 years on average. You don't see that in indexed annuities.
For more information on the mechanics of Index Universal Life and how this information can impact your practice, just click on the landing page address in the video description. We'll be right back with more from Tom Martin.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at CreativeOne.com.
In this segment, we're introducing you on how insurance carriers operate an Index Universal Life policy with their general accounts. All from Tom's popular article, Are Caps and Floors and IUL Realistic? And his best-selling book, The Other 8 Advantages of the Universal Life. Well, Tom, let's talk about this. This is kind of an interesting thought. When we're talking about indexed, I think of other things like, well, are we talking about, I know I can buy index in a regular fund like a Vanguard or Fidelity. I could buy it in an ETF. I could buy options straight to them. Now we're offering, as an insurance carriers, we're offering annuities this way, MEC life insurance contracts, non-MEC life insurance contracts. They could be indexed. We could even buy the S&P on a variable. So there's a lot of ways to do this, and there could be tax advantages. There could be dividend participation, depending upon which way we go. I just gave you the potpourri of how to do this. Now, when we're talking about this, I'm kind of curious, does Universal Life, when we're talking about it, why would I go to that and not buy a straight out fund?
Well, I think the big difference is certainly the guarantee. With an indexed universal life policy, you're not subject to loss of your account value due to market corrections. Worst case scenario, depending on the carrier, is either 0%, you sometimes see 1%, 2%, or 3% guarantees, and you don't have that with a variable product.
I want to ask you about that. If you see a 1% or 2% or 3% floor guaranteed payout on their crediting account, usually is the cap lower?
Yes. Well, generally it is. Generally
and is the spread, is it like, if I had a 3%, I probably should not really look past a 10% cap, right? You're not going to get anything higher than that, probably.
In today's market, it's not likely that you're going to see a cap of greater than 10% if it's got a floor of 3% per year. Matter of fact, I haven't seen a 3% floor in quite some time. Generally, if they have a floor greater than 0, there's a handful of carriers offering a 1% or a 2% cap.
Well, when we're talking about Index Universal Life, we're talking about a non-security, and we talk a little bit about the mechanics of how we use the insurance carrier's general account. Because you just said we can't lose anything, and the reason is because I think I'm understanding you is that the portfolio generates a certain interest. We take that interest performance off the portfolio and purchase our options. And if we don't exercise those options, we just lose the premium we paid. Is that correct?
That's essentially what happens. The insurance company starts by investing to meet their minimum guarantee. So if you have a $100,000 account value and they're saying a 0% floor, they're essentially guaranteeing that you're going to have $100,000 at the end of the year, minus, of course, your expenses. Sure. So they take a sum of money that's required for them to have $100,000 at year end. So if they're earning 5%, they generally have to put 95% in their fixed account earning 5%, so there's basically $100,000 left at the end of the year, and that gives them the 5% allowance to go out and buy the call options.
Okay, so if they're buying call options only with their earnings off their portfolio, and I'm assuming that most carriers are buying investment grade bonds. I don't think there's that much other assets. I mean, would that be true?
The insurance carrier has to invest in a very conservative portfolio. They're making very long-term bets. If they sell a policy to a 35-year-old, they might not be paying a death benefit for another 50 or 60 years. So they have to invest conservatively. The other thing is, life insurance carriers have very little flexibility to raise or change the premiums once they sell the policy. If you look at a property and casualty insurer, on the other hand, they make one-year bets, and at the end of the year, if they need to readjust their rates, they do that. Life insurance companies don't really have that flexibility to change their costs without driving away all their healthy customers if they do that. So they tend to invest very conservatively. And you'll see at most carriers, they have generally about 80% of their assets invested in bonds. Stock, you'll see, is a very small percentage. One of these carriers has 0% exposure to the stock market, but the other ones are 2, 3, 4%. So they tend to be very conservative. Now, if we drill down and look at those bonds, we'll see that the majority of the bonds are the very highest quality.
Yeah, I'm looking at investment grade bonds are going to be classified as class 1 and 2. When you get into non-investment grade, and I'm looking at just some of the carriers. I mean, hardly anybody has any bad issue bonds. I mean, so there's going to be quality.
Right.
When I look at this now, I'm looking at my duration, my classification, which is very high. And by the way, we're pulling from Vital Signs or from eBix, from their Vital Suite software. Excellent. I've been using this tool since like 1990. This is an excellent from the summary sheet of the convention blank. If you ever want to see what they're investing in, this is a really great piece of software for you to do that. So when I look at this, I know I'm going to only be able to take the performance from my bonds, from my general account, to invest in my options. I just want to make sure I understand that.
Yes.
That's it.
Yes. The majority of your money is invested in a very safe portfolio consisting primarily of investment-grade bonds, and that's what allows the 0% floor.
Well, for more information on the mechanics of Index Universal Life and how this information can impact your business, just click on the landing page address in the video description. And for more information on our shows, seminars, and workshops, just follow us on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.